In the first episode of our series about active and index investing, we highlighted two dimensions of these approaches to portfolio management: holding period and diversification. While these two dimensions are important, what turns out to be far more important in explaining the risk and return experienced by investors is their asset allocation. One famous study found that over 85% of the differences in risk and return between investors was explained by their asset allocation. So what is asset allocation? This term refers to how an investor divides or allocates their dollars among various kinds of assets. Today, investors have access to a dizzying and diverse universe of assets. One way to picture the array of options is to imagine a Rubiks Cube, the puzzle that drove people to distraction in the 1980s. Viewed from the top are broad categories of assets, including publicly traded stocks, bonds, and others. When viewed from the side, these assets can be classified according to where they are located, inside or outside the U.S. This cube represents an investor's global opportunity set. Now let's look at one corner of the cube, the stocks of all publicly traded companies in the world. Forming a new cube, global stocks, we further divide them into 9 categories where large, mid-size, and small companies form one axis, while the other separates stocks by the relative price, often called the value to growth axis. Viewed from the side, stocks are divided by geography and type of economy. This creates 27 unique asset classes just among global stocks. Not all asset classes are created equal. History demonstrates that some asset classes are riskier, some have had higher or lower returns, some are easier to access or less expensive to own. This relates to our active versus index conversation due to how each management style invests in these asset classes. An index publisher forms their list to include every security that fits into one or more of the boxes on the cube on a given date. The stock index of all U.S. large companies would list all stocks in the corresponding 3 boxes of our global stock cube. An index fund manager implements the publisher's list, buying and holding that list of companies until the publisher reconstitutes their list, often every 12 months. However, while the publisher waits a year to update their list, markets are repricing and revaluing those companies every day. Some companies that were large on the first day of the year may fall out of that classification during the year, while others may grow into it. Regardless of what is happening from day to day, the publisher's index list remains the same. An active manager might start the year thinking that U.S. small companies represent a better opportunity than U.S. large companies. They may buy some of the companies in those 3 boxes. During that year, the active manager may decide then that U.S. small companies are no longer the place to be, sell those holdings, and buy stocks of U.S. large companies. This is called turnover. The more actively managed a portfolio, the more turnover an investor is likely to see. In both cases, an investor planning to consistently own specific asset classes is getting something else. The index manager loses some of the asset class every day because the publisher only updates their list at certain intervals, while the active manager has relatively few constraints on which asset class to focus on from day to day. Academic research suggests the investor may be better served by funds and managers targeting specific asset classes, those who hold virtually every security that quantitatively belongs in the asset class each day. This enables the investor to get the results of their desired asset allocation more consistently. Often these investments end up being neither index funds nor traditionally actively managed funds. They represent a highly engineered approach designed to cost-efficiently capture the daily return of each asset class.